This is Trade Flow News, bringing you relevant news and insights from around the world. Trade Flow News, enabling trade for SMEs and economies worldwide.
Welcome back to Trade Flow TV. You know the drill. Markets move fast, and if you're not ahead, you're under. It is Friday morning, June 12th, 2026, and today we are zooming out from the central bank noise to focus entirely on the physical world. The global commodities complex is actively fracturing into distinct winners and losers, driven by physical supply chains, AI infrastructure, and a shifting geopolitical map. Let's get you caught up for the global open. First up, the 60-second commodities flash. Brent slides on dark transits. The energy squeeze is showing unexpected leakage. Brent crude oil has slipped to $92.49 a barrel, while WTI sits at $89.62. The price drop is being driven by reports that oil tankers are increasingly executing dark transits through the Strait of Hormuz, bypassing official blockades and successfully getting physical supply to the market. Look at the copper super squeeze. Industrial metals are on absolute fire. Copper is holding strong at $6.25 per pound, near its all-time highs. A massive collision between booming demand for AI data centers and severe mine supply disruptions in Chile and the DR Congo has created a structural market deficit. Meanwhile, precious metals cool off. While base metals rally, the shiny stuff is taking a breather. COMEX Gold has pulled back 0.73% to $4,078.20 per ounce, and silver has dipped near $63.99. A resilient US dollar and the expectation of higher for longer yields are prompting institutional profit-taking in the precious metals sector. Finally, notice the agricultural creep. Soft commodities are quietly surging. Arabica coffee jumped 1.25% to 251.50 US cents, and white sugar climbed 1.42% to $450.20. High energy and fertilizer costs stemming from the Middle East conflict are actively bleeding into global agricultural markets, cementing a secondary wave of food inflation. Let us take a deep dive into the aggressive divergence within the global commodities market, where industrial metals surge on tech demand while energy finds a temporary backdoor. The data hitting global terminals this morning proves that treating commodities as a single, uniform asset class is a surefire way to misallocate capital. Here is how underlying physical realities are dictating today's pricing. First is the metals super squeeze. We are witnessing a structural regime change in industrial metals. Unlike energy markets where supply is politically constrained, copper is facing a genuine physical deficit. Goldman Sachs recently highlighted a massive 640,000-ton copper shortage outside the US market. The energy transition and AI build-out require unprecedented wiring infrastructure. Furthermore, high diesel costs and shortages of sulfuric acid, a key mining input, are making it incredibly expensive to pull new ore out of the ground. If you are positioned in copper, you are riding a structural tailwind. This brings us to the Hormuz dark fleet. Why is oil trending down while the Middle East remains a live fire zone? The answer is maritime adaptation. Speculative paper traders expected Brent to hold above $100, but they underestimated the resilience of the global dark fleet. By turning off transponders, tankers are increasing flow to Asian markets. Next, watch the agricultural margin crush. Do not ignore the soft commodities complex. The steady rise in coffee, sugar, and cotton is a direct lagging indicator of the energy shock. High oil prices make marine freight expensive, but more importantly, they skyrocket the cost of petroleum-based fertilizers. Farmers globally are passing these costs down the supply chain. This agricultural creep is exactly why central banks like the ECB are trapped in hawkish rate hike cycles. They are fighting imported food and energy inflation that they cannot control with interest rates. Here is the trade flow take. Today requires extreme sector selectivity. The structural bull market in copper and base metals is heavily supported by the undeniable growth of global AI infrastructure. Meanwhile, the energy market is highly vulnerable to dark supply shifts. Rotate out of generalized commodity index funds, take targeted positions in industrial metal miners, and ensure you have long-term hedges against sticky agricultural inflation. Stay liquid, stay sharp. See you on the next one.
That is all for today's news on commodity markets. Stay tuned to Trade Flow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at Trade Flow News, which allows you to watch our program on your mobile device or desktop to receive information from there.